For many people, the loan approval process can appear unclear, with limited visibility into how lenders evaluate an application before reaching a decision. But lenders aren't looking at everything at once, and they aren't weighing it all equally. They actually check things in a rough order. And if you understand what they look at first, you can know exactly where to focus before you ever apply. Now, let me give you the framework lenders actually use, because it's real and it's been around forever. It's called the 5 C's of credit: capacity, character, capital, collateral, and conditions. Every lender is running some version of this in their head. But what most people don't realize is that they don't treat those 5 things as equals, and there's actually a clear frontrunner. The one they lead with is capacity. And capacity is just a formal word for your cash flow, your ability to actually repay. This is square one. Before a lender cares about anything else, they want to know this one thing. Does this business generate enough cash, reliably enough, to make the payments on this loan on top of everything it's already covering? If that answer is no, it almost doesn't matter how good everything else looks. This is why cash flow sits at the very center of nearly every lending decision, and why the cash flow videos throughout the channel matter so much for anyone thinking about borrowing. After capacity comes character, and that's your track record. Your credit, both personal and business, how you've handled any obligations in the past. The lender is asking themselves a simple question. When this business has owed money before, has it paid it back on time? Your credit history is the evidence. Third is capital. And this one many people when applying for a loan underestimate. Capital is your own skin in the game. How much has the owner invested, and does the business hold reserves? A lender feels much more confident lending to someone who has their own money committed and a cushion set aside, because to them it signals both commitment and resilience. This is exactly why cash reserves make a business more fundable. Fourth is collateral. What backs the loan if things go wrong? For secured lending, this is what the lender can fall back on. It's real, but understand where it sits. It's a backstop, not the headline. A lender would much rather be repaid from healthy cash flow than have to fall back on collateral. And fifth is conditions, the wider context. What the loan is actually for, what industry you're in, and the broader economic environment. These things shape the decision around the edges. So here's the honest takeaway, with everything said and done. Lenders lead with capacity. Can you repay this from your cash flow? Everything else is really just them managing the risk around that one answer. So if you're thinking about borrowing, the single most valuable thing you can do before you apply is get your cash flow clear and strong, because that's the first thing they check and the thing they weight most heavily. Understand that, and you stop guessing at what lenders want. You already know where they're looking first.